right, so today I'm gonna grade one person's paper in class just so you can see. I might do two more on Wednesday. We also have the team case on Wednesday, so we'll see how much time we have. But then today I'm going to walk through the entire paper 3 and 4, very high level, not all the written part. Excuse me. All right. Thank you. So here's a paper. And here's how I grade. So he did UPath, which is not a firm I know that much about. So, but an interesting company and results. So we got to start off with just the basics. So I'm going to just say, okay, path reported adjusted earnings. Here I've got to say adjusted earnings because you notice their reported earnings was a loss of 5 cents, but their adjusted earnings was 15 cents. I know this column for adjusted earnings says COMP. That's comparable. Comparable is the same thing as adjusted earnings. So it probably would be good to explain why, but adjusted earnings of $ 15 cents, which significantly the expected earnings of $0.65 or 131%. And a full 200% higher than prior year's 5 cents. All right, so I'm looking on the earnings, I'm looking for those numbers. Now, if he knows why they reported a negative 5 cents, reported earnings of negative 0.5 cents, then you say 0.15 cents after adjusting for whatever. Then that's all you have to ever say about the negative 5 cents. You never bring it up again. All right, there was some unusual item they had that caused them 20 cents lower earnings, but that 20 cents was added back. I don't know what it was. We'll see if this paper tells us. All right. If these two numbers are almost the same, you can't completely ignore the reported and just say they reported earnings of 15 cents. You don't have to say adjusted or that the adjusted was the same as reported. You just have to say, in this case, there's a huge difference. There's a good 20-cent difference. They went from a negative 5 cents to a positive 15, but the market's focused on the 15 cents. That's the adjusted number. Now, someone was asking me, what if this number is different in an article? It can be, because this is an adjusted number. There can be more than one version. The 5 cents should be the same everywhere. That should be the official gap. Although even there, it's possible which earnings per share. Remember in the accounting class, you have diluted, fully diluted, and all those different categories. So it's possible there can be a conflict there, but usually this number is well known. You can see that they've had adjustments, pretty significant adjustments every single quarter. So there's something wild going on with their earnings. Who knows what that adjustment is? I don't know enough about path to be able to say. All right, so let's see. So he said path. Okay, well, the first thing is, do you give me an introduction to the company and what you're going to be doing? So I'm looking for an introduction to company and something along the lines of what you're going to be doing. So he starts it off in this paper I'll be summarizing. So he gets full credit there. And then UPath is a global software company. He does that. So that's good. So something that says what you're doing in this paper, don't just start off with UPath is. Like, okay, well, why am I reading this paper? Wait, this paper must be about you. It's a lot better to say, in this paper, I'm going to give you a summary of whatever, the way he has it is actually really, really good. The abstract says what the paper is all about. And then he gives me a definition of the company. So tell me something about the company, especially a firm this wild like UPath, or however you pronounce it. Give me some sense of who this company is, because your boss may not know. All right. UPath's shattered earnings expectation of most analysts. They expected the firm to be 7 cents a share. The firm run reported earnings of 15, beating expected by 130%. When comparing the same quarter prior year, the firm's earnings report were 200% higher. He's got it all in there. I did it in one sentence. He did it in 4. So I'm a little more efficient than he is, but he's got that in there. He's got the actual versus expected. I don't remember all these comments are, but versus prior. Do give me any percents. You don't give me any percents, I do count off a little bit. Don't make your boss have to get out a calculator and figure out what the percent difference was. What if you have one of those companies, and I think we have one, where they go from a negative number to a positive number? We'll see if I can find one. Yeah, if you're going from a negative to a negative, we don't do percents on that because it's just strange. But I somewhat help you on that. I put not meaningful figure. In those cases, let's see if I can find any others. Yeah, that's UPath. So it's positive to positive, but there's negative numbers in between. Yeah, here's one. You went from a negative to a positive. In that case, don't give me percentage. It doesn't make sense. So you can say Pager beat expectations by 321% and switch from a negative 4 cents to a positive 8 cents. You just give the amounts and just point out that he went from a loss to a gain. All right. So you can't always do percent, but if you can do a percent, do a percent. All right. And then we got revenue, the exact same thing on revenue. Revenue and top line growth are the same thing. You can title it top line growth. You can title it revenue. One draft I saw they had both. They had top line growth and they had revenue and top line growth. So don't do that. Just have one section on revenue. So Path reported revenue of, and be real clear, don't say 309, $309 million. Which again, significantly. So what's significant on earnings? 20-30% significant on revenues, 4 or 5%. You're usually much closer on the revenues. All right. So 5% miss or beat on revenues is a much bigger deal than a 10% beat on earnings. All right. We tend to get revenues much, much closer. Significant beating expected revenue of 270 million. I don't know why I said 4 by 11% and 6.5%. I don't want to hit escape because that messes everything up. I don't know what I'm hitting. 6.5% higher than prior year's 290 million. So the market was actually expecting their revenues to be lower this year than last year. That's kind of amazing, and they were actually higher than last year's. So that's pretty impressive. Let me fix some of this. All right, so let's see if you got all that. Now, he's got the fiscal year. So if this is your fiscal years, so if you're doing fourth quarter, you can talk about the full year. It's not necessary. You can leave it out, but if you want to talk about the full year, you can. I don't look for that in the grading. I'm just looking for the quarter. Top line, UPath experienced increased growth in revenue in every quarter. In 2000, fourth quarter revenues came in at 209, beating expectations 278 by 11%. When compared to revenues last year, the revenues reported are 6.5% higher than 290. So he's got all of those in there. All right, so far he's doing pretty well, doing very well. Revenue for the entire, and then he did a full year. Again, you don't have to do full year, but you can. He put a graph in there. If you put a graph, watch. That's really busy, isn't it? I'd probably do the graph in millions, so I don't have these massive numbers. All right. Doesn't that graph look a little strange to you with all those numbers? It's hard to see it, but all those numbers. So yeah, so look at the graph, just kind of step back and make sure it's very, very pretty graph. There was a drastic increase in revenue in fourth quarter 2022, as seen in the graph, which was followed by a decline. Since the decline in revenues have returned to their trend, steady growth, we can compare revenue. Let's go to the second page. Is this the second page? Yeah, page 2, I think. Page 6, page 2. This looks like the next page. Wait, how do we get to one page where she is? When we compare revenue during the quarters of full year 23 to quarters prior year. Okay, so he decided to do quarter versus quarter. That's that's fine. Anything you want to add that you think adds extra to it, that's good to show. So essentially what it's looking like is revenues are up. The whole year it's been that way. Fourth quarter is actually the weakest improvement. So this looks like a firm that's in strong improvement. Each quarter in 2023 showed higher revenues. UPath has shown the ability to grow their customer base, and their quarterly revenues have showcased that another illustration of this growth is seen in their growth in subscription revenue. I can't tell which year is which. All right, so all right, so you see how he's switching, going from left to right to left. Don't do that. All right, I usually go earlier to later. All right, earliest on the left, latest on the right. So I would switch that. That gets confusing. So here, you definitely don't need pennies. You have millions of dollars, but I would probably put this in millions. So definitely take the pennies off, but I'd probably take the zeros off. He's going left to right here, and then suddenly he goes right to left. So I would switch this, because when I first looked at it, it goes, well, it doesn't look good. It's going down, but it's actually going up. So he's showing subscription level revenues. The last thing to analyze when comparing top line growth is composition of revenues. Being a software firm, Path is expected to gain a lot of its revenue from selling subscriptions as well as licensing. Here he breaks out the components. That's a good thing to do, showing some good inside information. For the most part, the revenue composition has not gone through any drastic changes. However, as the revenue grew, subscription revenue increased year on year, and eventually took a slight edge on the license. As the firm continues to grow, it's expected that subscriptions continue to increase in size as well as percentage of revenue. The firm places a tremendous amount of focus on ARR, meaning their priority taking care of clients. I don't know what ARR means, so you might need to explain that. Most of their clientele are firms and industries that can benefit from automation, such as financial services, manufacturing, and government. I'm maintaining this emphasis. I don't know what ARR means.
Annual recurring revenue.
Is it in the form? Is it defined somewhere?
Like it's your monthly recurring revenue minus your monthly recurring revenue churn times 12 months.
Okay. I don't use that term. So yeah, I don't use, you might assume I know that term. So maybe it is, it's not like ROE or something, but okay. Most of the clientele are firm. Okay, by maintaining this emphasis on this recurring revenue and continue to add customers within these industry path and continue their trend of increasing subscription revenue. All right, then to get down to bottom line growth. Here we can see their gross margins came in right on expected. Or a little above. Oh, no, actually above, sorry, a little above and well above last year. So beat by 56 and 120 basis points higher, and their net margin beat by 969 basis points and 868 basis points higher. In fact, they expected, again, their net margin to be lower than last year, although they did expect an increase in the gross margin. Now, a lot of you are going to struggle here with revenue up and earnings down, and that's what you expect in an inflationary environment. When you have inflation, revenues grow pretty well just because you raise prices, but your costs of goods sold, your advertising, your employee pay, all that's going to go up as well. So you're really after what is inflation doing to them? Are they able to increase their revenues as much as their expenses are going up? So here's a firm, it's hard to say. I mean, they're definitely, their revenues are up significantly, but you're also seeing increases, gross margins. You don't normally see increases in gross margin that significant, 121 basis points. It's a pretty ridiculously high gross margin, but this is pretty normal. You have to kind of somewhat adjust your thinking. I was looking at Microsoft earlier. Microsoft, these are the kind of companies, Adobe, that have 80% gross margins. I'm looking at Costco and you're talking, you know, 15-20% margins, gross margins. You know, you got to think about what industry you're in. So this is the industry where an 80% margin is not that uncommon, but still they had a fairly significant increase in their gross margin. And that's a pretty strong increase, actually quite dramatic increase in their net margin. And that's their first positive net margin they've had in the last 4 quarters. So that's 23% is pretty significant. Let's see what he says. You can call this bottom line growth, or you can just call it margins. It gets a little confusing if you call it bottom line growth because gross margins are not bottom line. So I almost think of it as margins, or talk about gross margins, and then you can do bottom line as the net margin, just from kind of the gross margins is pretty high up on the income statement. It's expected that they would have relatively good margins for fourth quarter. The firm reported adjusted gross margin of 87, which beat analyst expectations by 56 basis points. You could probably leave that out, right? Don't get too redundant. Which beat analyst expectations of 86 by 56 basis points. And then he used the full year. Here he didn't talk about versus prior year. I would throw the prior year in there. How he did versus a prior year. When examining bottom line growth, it is key to compare growth in earnings per share with growth in revenues. Earnings per share growth outpaces. So here he has a graph of the two, which is essentially what you're doing when you're looking at the EBITDA margin. So if the EBITDA margin is growing, that means earnings is growing faster than the revenue. So the margin helps you do that. I would probably throw the EBITDA margin in there. The gross margin should have been greater. Let's see. It seems as though earnings per share growth was greater than revenue growth. This means that gross margin would have been greater. Yeah, so earnings is EBITDA, gross margin is gross margin. So he's a little bit mixing gross and net margin in this discussion. So you say EPS growth was greater than revenue growth. That doesn't tell you gross margins are rising. You don't know that for sure. So there's a little bit of mixing up here. So it's a little confusing. Another highlight is the trend in gross margin in previous quarters and how it's changed over time. Gross margin has hovered between 84 and 88, which is very high. However, gross margin has declined since quarter one. There has been a slight rebound So he's kind of talking the graph here. Yeah, he keeps talking about gross margin here, so I'm not real sure why he keeps going back because yeah, EPS EPS is net income. I'm giving you EBITDA margins, so be real clear what you're talking about here. I don't give you net income anywhere in here. I give you EBITDA. Net income is the earnings per share. So this is earnings per share, which is after interest, after depreciation, after taxes. This is EBITDA, that's before interest, taxes, and depreciation. And then gross margin is a completely different number. So he's kind of flipping between those three, so I'm getting confused. So he'll probably need to tighten that up a little bit because it's a little bit confusing to me why he's trying to put those together. So it's possible all three of them can be radically off. It's possible you beat on gross margin, miss on EBITDA, but beat on earnings per share. I mean, it's perfectly possible. You can have inconsistencies with the three. And so what he's talking about here, it's hard to say exactly how he's connecting, although he keeps flipping back to gross margins, which is a little confusing to me. One key finding with gross margin is the amount of revenue they receive from professional services is less than the cost associated with producing that revenue, meaning they have a negative gross margin within that revenue stream. This is lack of profitability within the revenue stream is a really big graph below. So yeah, all right, so that's interesting. A little more discussion. Since these costs should only occur in the process of getting revenue from offsetting subscription, it is expected that the growth rates of both costs and revenue should be similar. So he's talking about one particular line of business. An additional metric of importance when discussing bottom line growth is EBITDA and net margin. And here he talks about the net margin. There's that 969. All right, so a little bit more discussion. All right, so I might, on the bottom line, I might give him like a 90 because it's just confusing to me. So I'm in trouble following the numbers, but generally he's got it all covered in there. Then on the analysis, during the earnings call, so he went on the earnings call. I always give a lot of credit for that. Management had lots of positive things to say about previous year, as well as the positive outlook for the upcoming year. We believe the strong finish to the year accelerates our path of profitability. I'm not sure. Oh, path to profitability. I thought they had kind of, since their path, they had some kind of special term, but no, path to profitability, and serves as the baseline for our fiscal year 2024 non-GAAP operating margin outlook of 9.5%. He followed this by reinforcing the goals, the driving growth at scale, as well as increasing non-GAAP operating margin. He goes on to mention key structure changes. So it looks like he's got some good discussion. I'm not going to go through it all in here in detail. Looks pretty good. Yeah, I probably somewhere in the 90 to 100% range on that. I'll do 95 just because I don't have time to read it in detail today. And then market reaction. The shares rose in the day following the earnings announcement. On the day of the announcement day, shares ended the day at 1464. Prior to announcement, the next day, the following announcement, shares opened at 1716, a 17.21%. Throughout the day, the stock reached a high of 1808. The seen graph below. Yeah, graph above, I guess. It won't let me do it. The price change post earnings was drastic. Was the market responded very positively to earnings news. One key thing to compare is to be competitor to industry. The S&P and industry, it lies in a whole. Oracle, one of its competitors, was up 2.2%. The S&P was up 1.76. I see the Russell, the index in tech had a price increase of 3.7. So yeah, when you're up 17%, it's pretty obvious it's responding to your earnings. So you can certainly say, I think he's maybe making it a little too strong that like 2.2% was not strong or disappointing. So I might say it more of they're up a whopping 17.6%. And while obviously the market, I mean, this is on a strong day for the market, and the market was up X%, Oracle's up X%, but obviously the market was reacting very strongly to this earnings report. This word bothers me a little bit. Only up 2.22%. That's pretty good. So you got to find some way to say, yeah, the market was up strong. It was a strong day for the market. However, they're up 17%. Obviously, the market's reacting very strongly there. All right. So on the market reaction, some of the things I look for. So first of all, there's got to be some graphs in there. So I need to see a graph. You always want to see a graph. I try to give them a 90 to 95. What I look for here is students finding other things to bring in, especially with tech stocks. 2022 was such a horrible year for tech stocks, and your boss that you're writing this to may not be that closely aware of path because this is not a huge company. So I might do a year-to-date chart. I might do a year-to-date chart and then talk about how that compared to 2022. I don't know how they did in 2022. You know, I might, if they were down 2022, you might say, obviously tech stocks are down 2022. Path was down a good 40-something% in 2022, but year-to-date, they're up X%, where tech stocks are only up X% or something like that, you know, or do a graph, something like that. Anything you can do, give some context to it. You want to make sure you focus on that earnings date, no question, but giving some context would be strong. Clarity, probably give 92, just because that margin discussion threw me off. And critical thinking, 95, maybe a little higher. I give them good marks on critical thinking because they listen to the conference calls. That's always good. So looks like it's an A shape. It could certainly be strengthened on some of the clarity, I think, around especially that margin section. Questions on that? I've had a few people confused with all these numbers. I don't like the word comp. So if you want to just change it to adjusted earnings, that's perfectly fine. That's what it really is. It's called comp because that's the number that the market's comparing its expectations to. Or that what? I don't know what their source is. Typically, it's a place like Reuters or, you know, there's some official source, Reuters or Thompson or someone, but I don't know in this place. Bloomberg may have their own source that they're bringing in.
I adjusted earnings and reported like are right next to each other, they mirror each other. You said that I don't need to write the report.
Yeah, if it's off like a penny or something, I would completely ignore it. The market is entirely focused on this number. They really are. The fact that could be a little bit off is because people have a slightly different opinion. Management's going to talk to it. They had something unusual, so they'll definitely really management's the one telling you that number. That we had a major pension write-off this quarter. I remember when GM had to write off $16 billion in one quarter. Yeah, that's. I think I should have shown y'all this. I'll have to find it. Maybe I'll remember. But I remember Best Buy once. I may have told y'all this earlier, but the reported number was like -$4, and the comparable was like +$2. I mean, it was massive. When you see something like that, you almost have to talk about it. So like in this paper, I don't think he did. I would add something. Because the reported was a much different number than the comparable. So I would put one start statement in there. I mean, you're talking not just a big difference, but it's a negative versus a positive. So I would probably, and this company, because they're always like that, it's probably the same thing every time. So I would even probably say that. So they reported earnings of -5 cents. However, this is 15 cents after adjusting for their normal adjustment for blank. You know, if it is the same thing every time. And you'll usually see that in articles. They will start with this -5 cents in an article, but quickly go to the 15, and then everything's off to 15 cents after that. Now, why would a firm have the exact same adjustment every single time? There may be some accounting thing that they have to do for GAAP accounting that the market says, we don't like that accounting. We don't like how you do it. Netflix is a little interesting. I'm not sure exactly Netflix, how they handle some of their production costs versus capitalizing versus expense, and some things that causes some strange differences. But for a firm like that, every quarter is different. It's rare for us to see differences in revenue, but it's possible. All right, other questions? Does that help to grade a paper in the class, or does it just freak you out? All right. Right, so now I want to walk through papers 3 and 4, which I know you're not thinking about until after Friday, but at least have this on video, and I have a video that does this exact same thing as well. I might pick a different company this time, so we don't talk Walmart all the time. So let's look high level, and then let's look at what we're missing. In the investment society, we have some teams that are at this point for their valuation, and they're going through this. So we have paper 3, which is the discount rate, and paper 4, which is the valuation. So paper 3, you need 3 things. You need a risk-free rate, market risk premium, and a beta. And then you're going to plug into CAPM. So that's paper 3. Now, when I started my career, piece of cake, risk-free rate, 10-year treasury, market risk premium, Ibbotson, you got his book, pulled out the market risk premium. Beta, you just look that up. 3 numbers, you look all of them up, piece of cake. And then about 10 years, 20 years in, the risk-free rate dropped almost to 0. So we're like, well, do we need to adjust that? That's kind of a problem. We switched from the historical market risk premium to the implied, and then we had a big debate about the implied. And then there's a lot of debate about beta. So we went from all 3 numbers being these obvious numbers you look up to all 3 numbers being highly debated. Now we're back into a place where they're not as highly debated. So risk-free rate, you can just use the current 10-year treasury. Why 10-year? Why not 5-year? Why not 1 month? Why not 3 months? I've always used a 10-year, but there are people who use shorter rates. We were looking at a Capital IQ model, and their model used, I think, the 3-month treasury, but you could easily change it to the 10-year if you wanted to. So they allowed you to do that. 10 is just the most common. There's a good reason. 10-year is the only interest rate on Yahoo Finance. It's used a lot. It's usually used to price 30-year mortgages. A lot of people use it for the stock market. So pretty common. The market risk premium, I'm gonna essentially push you to the implied approach, and we'll talk about that. It is the most common approach now. It used to be historical, but now it's the implied approach. And in beta, we already did that. It's that 4-step process. Y'all remember that? What kind of company is it? Defensive or cyclical, operating leverage, financial leverage, and look at the history. That sound familiar? We did that already, so you'll do that process. So beta is a big part of this paper, no question. And then plug it in the CAPM, that's a piece of cake. That's a pretty simple formula. So that's paper 3. Paper 4, you have your discount rate. Paper 3. Paper 3 and paper 4, it's really one paper. So it's one paper, but it counts as 2, but you're going to turn it in as one paper. And I wouldn't write it as 2 separate papers. Even if it's in one document, don't go, hey, here's paper 3, just write it as one big paper. And then you're going to need growth rates. You have long-term and short-term, and the H, the timing. And some of this, especially the long-term, tie to paper 3. You also need inflation for one of our models. That you're going to tie paper 3. So some of the data you need, it's going to be consistent. You want it to be consistent with paper 3, but you still need to mention it again. You can use the exact same inflation rate in 3 and 4. You should still say, as discussed above, and determining a discount rate, my inflation rate is 2%. So restate it again, just in case, someone might think you have a different rate between the two. And then you're going to do 3 valuations. We already talked about that. The Gordon growth, the H model, and the capitalized earnings model. And then you're going to have a recommendation versus the current price. Make sure the current price is in there. I've had students turn in the paper without even mentioning the current price. That would be really bizarre. So you have a valuation, what you think it's worth. Obviously, you can go compare it to what it's actually trading for. So that would be really, really critical. So that is it. That's the paper. Risk-free rate might be a paragraph. Just acknowledge the fact that this rate has been so low in recent years, but now it's back to more normal levels. So you can just use that rate. If you watch the video, I probably get much more into the rate being low because it was really low when the video was written. So you don't have to do the approaches there. And I want to spend a little time on the market risk premium today.
What's a good percentage?
Well, we'll talk about that. So I'll go through. We're going to go through because we haven't really talked market risk premium at all yet. So, right, I don't think I've even mentioned it yet, have I? I don't remember even talking about it yet. So I got to go through the whole thing. So we'll talk about that. I've done some recent math that I can show y'all. We probably won't have time today, where I updated that study that I put out there that's really pretty old. And my curiosity was, has anything radically changed with buyback since that was written? So I can show y'all some of that. And it hasn't changed all that much. All right, so we need to spend a little bit of time here. As far as paper 4, we've talked through everything. I'm just going to do it again specific to a company so you can see, because remember on the short term, I gave you 3 approaches plus subjective opinion. So I've already given you some approaches there. And we worked through these models. And there are students on these models that make some really horrendous math errors that make me really nervous, because if they made those math errors on the exam, they're going to lose a lot of points. So that I always worry about. I mean, just egregious errors. I'm like 4%, but using 4. Does 4% equal 4? What is 4? It's 400%. There's a big difference between 4% and 400%. So that worries me. That's students that are just like too much into the weeds, so their brains are not stepping back to think about what they're doing. And so they use 4 instead of 4%, and so they get this huge negative number, and then they write that huge negative number down on the paper, and that makes no sense to me at all. Somehow some students have they just turned their minds off. Maybe because we're giving you multiple choice exams or something, but don't be like that. Stop and think about what you're doing. You may have classes, you don't have to do that, so you got into the habit of doing that, but don't get in the habit of doing that. You got to always step back and think, hey, does this even make any sense? What number am I getting here? What's going on here? So the way I do this is I plug in all your assumptions, and I should get the same price you got. If I don't, then I'm really kind of irritated because now I got to figure out what you did. So that's going to slow me down. So be careful. It saves me time. And then I might even email you to say, boy, you really need to be careful in these formulas. You may not get any points back on the paper, but I want to make sure, if you're making these kind of errors, I don't want you to make them on the exam. Another problem is the parentheses. Make sure you have the parentheses. Remember in the H model, you got extra percents, make sure you know where the percent starts and stop. So what some people do in the H model is they've got dividend 0 times 1 plus long-term growth plus dividend 0 times H times short-term growth, it's long-term growth divided by KE minus long-term growth. And what they actually do is they take this plus that. And that's not the right answer. It's not dividend 0 plus 1 times long-term growth plus all of this. It is all of this divided by that. All right. So students do that. And that's obviously going to give you a really bad answer. You can check it. You should be able to, if your short-term growth rate is higher than your long-term growth rate, the H model has to give you a higher number than Gordon growth. So that should tell you, if you get $80 on Gordon growth, you get $12 on the H model, then you probably did something wrong and you should go back and recheck it. All right. So I have some formula errors, some pretty basic formula errors. I think most students can handle this math. This is really simple math. So I really think it's a matter of students are just moving too fast, sloppy, and then they're not stopping to think about what they did. They're just like plugging a number in because that's what the calculator said. And you never want to do that in finance. You always got to ask the question, does this even make sense? All right, let's talk about the market risk premium. It's the last thing we haven't covered yet. So we'll get into risk-free rate. Essentially now you can use the 10-year treasury, but the market risk premium, also known as the equity risk premium, it applies to all stocks equally. Now I realize there is like small company premium. There are other premiums. For our purposes, there's going to be one market risk premium. So it's the premium, the risk premium you need just for the fact that you're investing in the stock market. How much do you need on a risk-free rate? So if you're talking about, hey, what return do I need on the S&P 500 stock index fund? How much extra return do I need over the risk-free treasury to get me in the S&P 500? So it's that risk premium that applies to all stocks. It is a subjective number. It should be a personal number. It should be what do you need, but that's not the way finance is set up. Finance is set up to do the market risk premium for the average investor. And there's books and books and books. I've never yet seen a book written on how do you come up with your market risk premium, even though theoretically that's what you should be after. Every book I've seen on market risk premium is what is the premium for the average investor? If you're not the average investor, then what do you care? But that's what we do on all these papers, all right? And that's what the implied approach does. So it's the average investor's market risk premium. And we're going to use the implied approach. So let me show you the implied approach just by hand because we used to use the historical approach. So when I started my career, everybody was using the historical approach. It's a guy named Roger Ibbotson that provided all the data, and that's what we use. And his approach was you take historical return on stocks minus historical yields on treasuries. He just says, how much have stocks earned over treasuries historically? And so his assumption is stock investors got the extra return they expected and required in the past. That is, no surprises. So if they got an extra 5% return, that's what they needed when they got in the stock market. To get if they got an extra 7% return over treasuries, that's what they needed. That's what they expected. Is it possible the last 50, 70, well, Ibbotson goes back to 1922, so we're 100 years, wow. We're up to 100 years now. Is it possible the last 100 years stockholders did a lot better than they were expecting and required? Or did a lot worse? That's certainly possible, isn't it? But Ibbotson was assuming, hey, if they made 11 versus 5, so they made 6% extra return, that must have been what they were expecting, what they were pricing, what they got. The implied approach is more forward-looking, right? And I remember when we switched from the implied I don't know if I gave you this article or not, but I'll see if I can find it. I think I did. No, I didn't, but let me find it because I know I've provided it in other classes. Pretty famous article. So this is one I changed my approach. This was written back in 2002, so 20 years ago. So some of y'all are like, well, I assume you're all alive then, but you're pretty young. How many of y'all were thinking of market risk premium in 2002? Anybody? Probably not. All right, so this is it, written by these two guys. So there was a conference on the market risk premium. They presented thousands of papers. One of the guys who worked for me, he went to the conference. He brought back all the papers on a big disc. It was pretty cool. Most of them were horrible, unreadable papers, overly quantitative, overly theoretical. This one was very readable and very logical, and this is what got us on the implied approach. And you'll notice in here, they refer to this number, and I forget where I think they call it the most important number in finance. I can't remember. It's either, you'll see it either the most important number in finance or the most important number in investing. So I don't know which they use in this paper. Huh?
You use control that.
Yeah, I don't know how many times they use either one of those words. Why equity risk premium is the most important number in investing. I've seen it as part of finance as well. I don't know if they actually answer that question. I'm sure they do. And so they came in with the implied approach. As soon as I saw it, I thought, okay, that makes more sense than the historical approach. So we immediately moved to the implied approach where I was, and I think a lot of people did. So this was really, really good paper. I think if you take my security analysis class, I think they made one major mistake in this paper, which one thing that they did that I don't use, but I won't talk about it here, but I think they made one major error. So what does the implied approach say? Well, there's a few assumptions. First of all, the market risk premium or equity risk premium is unknowable. There's no place to go get it. History only tells you what you actually got. It doesn't tell you what you needed to get. So history was the outcome. It's what we got. It's not what we expected. It wasn't what we required. It's what we got. The other thing is history assumes risk has not changed 100. Is that true? Are stock markets the exact same risk today that they were 100 years ago? So, using history like that, it's kind of you're implying that the market got exactly what they required and history hasn't changed. Markets are just as risky today as they were in the past. I actually think markets are a little far less risky today than they have been in the past. And you can also not just say risk, but cost. It's much cheaper to buy stocks today. If it's much cheaper, you don't need as much as a risk premium because your expenses are lower. We talked about that earlier when we talked about this, the stock market's history. So market risk premium is unknowable. History is unreliable. But we can say investors are rational. So what the implied approach says is we can determine an expected return in stocks. All right, we're going to talk about that. That's what Thomas was asking about, that expected return on stocks. How do you handle stock buybacks and that expected return on stocks? We already talked about this earlier. You put this on exam 1. And they're going to say the expected return in stocks should equal the required return in stocks. The required return on stocks, that's for the market risk premium is. The required return on stocks minus the risk-free rate is your market risk premium. Why is it the required return? It's return you need to compensate you for risk. We can't go get the required return anywhere. Some people say surveys, you can't do surveys. Surveys are entirely unreliable. Plus, if you do surveys, they're probably all using the implied approach anyway. So you can't use surveys. There's really no place to go get the required. You can't go out to investors and say, hey, what do you require stocks to make so you have your risk covered? That's not going to work. But we can figure out the expected return on stocks. Now, why should these be the same? If we expect stocks to make 7% and require them to make 9%, what happens? Say, boy, I need 9% to compensate for my risk. The stock market's price give me 7%, so what are you going to do? You be buying stocks? You'd be selling stocks. What's going to happen to the stock market? It's going to go up or go down? It's going to go down. It's going to crash. How far is it going to crash? Market sells off until the expected return equals what? 9%. So people are like, start, hey, I need 9%. I can only get 7. I'm not gonna buy stocks. I get out. Stock market falls 15, 20% so that you now have an expected return of 9% going forward. Now I'm fine. I'll get back into the stock market. If we expect, boy, I wish I could type. I have a pinched nerve in my left arm, so I have a very numb index finger, so I can't even feel the keys. So I have an excuse. Expect stocks to earn 10% and require an 8% return. What's going to happen then? You're going to love stocks. You're going to be out there buying stocks. What's going to happen in the stock market? The price is going to go up until when? The expected return comes down to 8%, and you get exactly what you need. So, and that makes perfect sense. It's not like investors are, wow, I really need 9%. Market's only priced for 7, but I can just keep on buying stocks. That's not a rational thing to do. So it makes sense that the required return that we can observe should equal the expected return that we can observe. And so what does the rest of this paper do? Well, they say, where does the return on a stock market come from? They say there's an income return. This should look really familiar to you. Dividend yield plus earnings growth. Does that sound familiar? Dividend yield plus earnings plus repricing. What is repricing? Repricing is the market's mispriced. It's that 7% versus 9%. That's where I think they make an error in their model. I might tell you, we should talk about it. It's pretty important, but we'll see. We may not have time. Exactly what I talked about. What they do, though, is they break this piece out. Nominal earnings growth, that's inflation plus real earnings growth. They break the two pieces out. So they actually, so you can see it right here. The return on stocks is dividends over price. Dividends over price, that's the dividend yield. And the thing Thomas was talking about was the change in the number of shares. That's the stock buyback. Plus I plus G. I is inflation. G is real earnings growth. So that I plus G is just expected earnings growth. And then the change in PE, what's the change in PE? That's the repricing. We're ignoring the change in PE. Not only are we ignoring it, but I think they should have ignored it. That's the error I think they made in their model. And the rest of this paper, what they do is they try to calculate each one of these pieces. Here's a historical. At the time they wrote this in 2001, right after the dot-com crash, stocks long-term return, they go back to 26. So I guess Ibbotson goes back to 26. Stocks had made on average 10.7%, 4.4 came from income return, 1.7 was real growth in earnings, 3% was inflation, and 1.5% was PE expansion. PE rates went from whatever to whatever. That's the history. But what they're saying, they're asking is, what can we expect on each one of these going forward? And that's what they do. And they give you a bunch of data. This article is still pretty interesting. They do update this analysis, I think, every year. I just don't have access to it. So I can't actually give you the data. But they have a lot of really good discussion here. So it's actually a pretty interesting article, even though it's 20 years old. And then they come back to their recommendations. And they come up with 7.5%. Now, 7.5% is not the market risk premium. That's the expected return on stocks. The market risk premium is the expected return on stocks minus the 10-year treasury yield, right? So make sure you don't make that error. Some of your classes talk about the market risk. Some of y'all have CAPM. I've seen it two ways: risk-free rate plus beta times the market risk premium. I've seen some risk-free rate plus beta times the market return minus risk-free rate. It's the same formula. It's just the market risk premium is the expected market return minus the risk-free rate. I don't do this one. I don't know anyone in my profession that does that. In fact, you can always tell when you're talking to a professor or a college student because you'll see that second formula. When you're out there in practice, you'll see the first formula. No one in my whole career has used that second formula, but you see it in textbook. Y'all probably have seen this? Have y'all in some of the other textbooks, the second formula? That's pretty common. I know the fact exam does it that way, but to me, it just looks strange. Why are you doing that? It's a whole extra step. I mean, it's the market risk premium. You just use the market risk premium. But what they're coming up with is this number. So the market risk premium is this number minus the market risk-free rate. So their final recommendation is an income return of 225. How did they get that? Well, the dividend yield was about 1.5%, and they added 0.75 back for stock buybacks. Earnings growth, they used 3.5%. Why? That's about how fast the U.S. economy is going to grow. Productivity plus employment, y'all remember that? Productivity plus labor growth, they got 3.5%. Expected inflation, 2.5%, and then the error. We only got 10. Well, let's talk about this error. There's times I wish I could debate. You know, it sounds crazy. I want to debate people that are a lot smarter than I am, but I do. I don't care if I look stupid as long as I learn something. And there's no better way to learn something than debate people in public because you're going to remember it the rest of your life. So they're saying we should use this in pricing stocks. Well, essentially what they're saying is the stock market's overvalued. So we need to reduce our expected return by that. Well, if you think the stock market's overvalued, but you use 7.5% and the value stocks, you're going to discover that the stocks aren't overvalued because you're using too low of a discount rate. What discount rate should you use? You should use 8.25. And when you do that, what's going to happen? You're going to price stocks and a lot of them are going to look overvalued. Why are they going to look overvalued? Because you believe what? You believe the stock market's overvalued. Now I ask you, should you use a discount rate that makes stocks look well valued when you believe they're overvalued? Or should you use a discount rate that makes the stocks look overvalued when you believe they're overvalued? Which of those two make more sense to you? Any opinions? Should you use a discount rate to make stocks look well valued when you think they're overvalued? Is that a good answer? So I would use 8.25. Use 8.25. I didn't discover a lot of stocks look overvalued. And why do they look overvalued? Because you believe they're overvalued. That works for me. They're essentially saying, you know what, ignore the fact you think the stock market is overvalued. Just use a lower rate. You can keep buying stocks. It's like, why would anybody do that? That makes no sense to me. So I would strongly disagree with them on that. I agree with them everywhere down here. And you can see why I ignore that repricing. I'm going to say, hey, here's what I expect stocks to make. I'm going to use that my discount rate. Or this is what I'm essentially, I'm saying this is what I think the average investor thinks stocks are going to make. I use that in my discount rate. If I get stocks overvalued, then I'm not going to buy them, and that's going to be good because I believe the stock market is overvalued. So anyway, I think they made a mistake there. But other than that, I think it's a pretty good paper. And they do go in quite a bit of detail. You know, that 3.5% actually is a pretty interesting discussion because you're going to see the exact same things we talked about, which are productivity. Well, look right here. Labor force growth, productivity growth. That sounds familiar, doesn't it? So some of it, I don't know if I stole that from them or if I saw it somewhere else. I can't remember. You know, you have a 30-year career. You don't know where you got anything. But interesting discussion. But definitely labor growth and productivity are the key to that 3.5% because they're tying, you see what they're doing? They're tying earnings growth to economic growth. Exactly like what we talked about in class. So good paper. Right. So to do the market risk premium, you have to have an expected, you have to have a dividend yield and expected return on stocks. So our expected earnings growth. So market risk premium is going to be expected return stocks minus the risk-free rate. Expected return stocks will equal the dividend yield plus expected earnings growth. The dividend yield is going to equal the current dividend yield plus, maybe, I'll leave it up to you, buyback yield. Why the buyback yield? For my whole career, we didn't have to worry about the buyback yield because firms were issuing more stocks than they were buying back. So it was actually a negative number. But the last 15, 20 years, firms have been buying more stock back and they're issuing new stock. So it's actually a really significant way they're getting cash back to their investors. So you need to adjust for that. So we'll talk about that. I'll give you the most current numbers. And then expected earnings growth is going to be a function of expected economic growth it's going to equal expected productivity growth plus expected labor growth plus expected inflation. Key is the long term. I'm not talking expected productivity growth next quarter. I have students go out and get a forecast for next quarter or next year. That's not what we're talking about. We're talking the next 50 years. All right. Same thing with inflation. We're not talking, what do you think inflation is going to be next year or next quarter? That might be 4, 5, 6%. That's not what we're talking about. We're talking over the very, very long term. All right. So these are long-term numbers. We've already talked through that earlier in the class because it's the same concept. Right. So some of this stuff you're going to have in other places. So the expected inflation, if you're going to use the capitalized earnings model, we use expected inflation in there. So there's 2 places you can use that expected inflation. Expected earnings growth in paper 4, you need a long-term growth for your company. There's a good chance the long-term growth rate you're going to assume for your company is going to be real close to the long-term growth rate you expect for the stock market. It makes a lot of sense. Eventually, Google is going to be growing as fast as everybody else, not 20, 30%. That makes a lot of sense. Most students do that. I still want you to discuss it. If you're expecting the earnings of the stock market to grow at 5%, do you think Walmart's going to grow their earnings at 5%? Or maybe it's already a big company. It's already saturated this market. It's probably going to grow. You remember, big companies, ultimately, they can grow with population growth plus inflation. It's hard to grow much more than that. So you don't have to use the same number, but you're definitely going to reference it. If you expect the economy to grow at 5%, your long-term growth for your company in paper 4 is probably going to be somewhere in that neighborhood. So there are linkages between these. And so what we're going to do is we're going to walk through all of these assumptions. So the risk-free rate, we maybe will handle that one right now. So essentially what you do is you get the current 10-year treasury, or you can use the 1 month or the 30-year. If you do that, you need to write another 47 pages explaining why you're using the 1 month or the 30-year. All right, there's good reasons why we don't use the 1 month. It's too volatile of a rate, so it's going to make your valuations go all over the place. Good reason why we don't use a 30-year. 30-year is a very specific supply and demand market, has very specific investors. It doesn't always move the way expected to. The 10-year is I'll just assure you, use the 10-year and your first job, you're gonna be in good company. That's the overwhelming majority of people use the 10-year. So if you use a 10-year, you just use the 10-year. If you use anything else, you got to explain why you're using something else. Now, USAA, Bob Davis used the 5-year treasury. I don't know why, but he used the 5-year. Fine, I didn't, he was the CEO, I wasn't. So you want to use the 5-year, that's fine. But if you use the 10-year, you don't explain much. But you might discuss its history. Easiest way to do that is just put a graph in there and just show, a few years ago, the risk-free rate may have needed to be adjusted because it had gotten so low as 0.5%. As you can see in this graph, we're back to more normal levels for the 10-year, although I don't know if we're kind of getting to more abnormal levels again, aren't we? We've had quite a rally. And did y'all watch the employment report on Friday? Anybody read it? I was hoping to get y'all hooked on that. Sounds like I failed on that. So now we're back up to 3.4. Wow, what are bonds doing today? It's a pretty hefty sell-off, isn't it? That's like a 2 sigma event today, but we're still below 3.5%, but we're still well above 2. Below 2 is where I get a little nervous about the risk-free rate because that sounds sub-inflation to me. That means negative real yields. I don't believe in long-term negative real yields. So below 2 doesn't make sense to me. I realize 3.4 is below current inflation, but it's probably not below long-term inflation. So you can probably get away with doing a 3.41% 10-year treasury. All right. So y'all see what we're going to do next class. We're going to walk through the entire papers 3 and 4 and talk about what the years. All right. So here's your assumptions. This should be a fairly gimme question on the exam. This is just plugging numbers in. Is everybody? So I gave you the discount rate, inflation, dividends 0, earnings per share 0, long-term growth. So short-term growth is what here? 12%. And your H is what here? 3 because it's 6 years. All right. So even discount model, pretty straightforward. Dividend 0 times 1 plus long-term growth divided by long-term growth divided by KE minus long-term growth. All right, I see that answer on one of ours. H model, the same thing again, except we're going to add dividend 0 times H times short-term growth minus long-term growth. So very simple. The difference in those two is 2310. What should that be? Well, it's that second part of the equation. Dividend 0 times H times short-term growth minus long-term growth divided by KE minus long-term growth. 2310. So you can double check and make sure you got that. And then the cap earnings looks exactly the same as dividend discount model, except we're going to use earnings per share instead of dividends. We're going to use inflation instead of long-term growth. But other than that, 62, right? Team 1 got them all. Team 2, so yeah, I'm seeing, did everybody team get them all right? First 2 teams, y'all recognizing those numbers? All right, so this one may not give you any space, but at least you won't lose space. So, all right, good. All right, let's look at another paper too, just real quickly. They're going to do Petco. So if you look down at Petco's data, this is one where you have a big difference between reported and adjusted. A good, oh wow, 7 cents. So almost, almost 50% added on. So I would say on them, Petco reported earnings per share of 16 cents, 23 cents after adjusting for, and we'll see if she has that in her paper. Missing expectations of 24 cents, 24.1 cents by 4.56%, and alarming, I say alarming, 17.86% below prior year's 28 cents. On revenue, they reported revenue of 1.6 billion, slightly missing expectations by 0.57%, but 4.23% above last year's. All right, so here's maybe the case where earnings really missed, really fell, but revenues were right in line. So that sounds like an inflation story to me, but we'll see. Right, when inflation's an issue, you start seeing margins getting squeezed. So revenue looks okay, but margins, earnings start. So let's see if that's the issue for them. So let's see what they actually say. All right, so Petco was established. So I'd probably give like 80% here. Remember, you want to say in this paper, I'm going to. You either started the paper like that, and they may have this in it. So I'm doing fast grading here. Or you can do like the paper we saw last class, you have an abstract that says that. But all right, don't, especially if you're going to put this on LinkedIn, don't have a paper as like they have to figure out what the paper is about. Just tell them up front. This isn't Ernest Hemingway writing. Ernest Hemingway didn't say this story is about a man who's going fishing and it's going to be really, really bad at the end. He doesn't start his stories like that, but that's Hemingway. You're not Hemingway. You're not writing the next great novels. So just tell them what you're going to tell them and then summarize it at the end. All right, EPS versus actual. They reported fourth quarter earnings on March 24th. Their stock price today. Now they're going right to the stock price. You can do that. There's a sudden 9.4% of the price at 839, a decrease of $1.78. Now they say, I believe the stock is underpriced. I don't know how you would say that in this paper because that's papers 3 and 4. So maybe they did an additional analysis, but you don't need to say in this paper, you're not talking where the stock's overpriced. If your boss asks you to do an earnings report, you really don't want to say, hey, I think the stock's overpriced unless they ask you to do that, because that's really a completely separate thing, but you can. If they want to do Petco for their papers 3 and 4, they certainly can. And then they'll see if they still agree that it's overpriced or underpriced. So yeah, they cover the market reaction. We'll see if I'll do 85 right now. And we'll come back and see what else they talk about there. Reported earnings of 23 cents, falling short of expected by 4.5%, and it was a 17.8% decrease from fourth quarter last year at 28 cents. Whether give 100 or not here, it really, they need to say something about the 16 versus the 23. It can be really, really fast, just like I have it in mind, but I would try to find that out. So a little bit of discussion here, some charts. The company's reported earnings on an adjusted basis, so it may not directly compare the analysts. The adjusted numbers were analysts reported revealed. So here she does talk about that. Doesn't know exactly why, you don't always know. Usually if you find an article, they'll tell you why, usually in a quick parentheses, when it's that big of a difference. If it's not that big of a difference, they'll ignore it entirely. All right, so I'd probably give 100% because she acknowledged it. All right, then revenue side. Petco reported revenues of 1.58, missing estimates by 0.5. However, they still had an amazing increase compared to last year's number. All right, so those are there. I mean, these are easy points, right? Wouldn't it be really disappointing to lose points there? It'd be really sad because that's easy. You just give the numbers. All right. Revenue growth has been driven by continued services vet and grooming. In addition, Petco continue to grow in, the copy didn't work too well. So she has a good discussion here. Expects 23 to grow by 2% to 4%. There is possibility that, I'm not sure what the word of course means. Does the term of course and obviously mean the same thing? So obviously you mean you should just know. That would be unusual here. She used the term of course. When I see of course, it doesn't mean obviously. It means as a pattern you're used to seeing. I don't know if I'd use that. I'd be more explicit. They're expecting growth similar to what they've seen in the past or something like that. But I'm kind of picky on wording because you put a phrase in there. I'm like, you say, of course, that's telling me something. I don't count off for that in the paper, but I do. Y'all need to be really, really deliberate writers. All right. When you pick words, think about it, read it out loud, think about why you picked that particular word. This student's a very good writer, so I'm kind of being picky, but still. All right. There are still other risks like inflation. So then she has a good quote. We are more and more becoming a service business. I noticed that with Petco. I took my cat there once. My cat hated it. It was a horrible experience. My cat hates everything, so it wasn't all that unexpected. But I don't know if y'all have tried that service. It's cheaper than what some of the other places are where they get more hands-on. So it's kind of like your pet's just in there and you hope someone talks to it. Dogs seem to do a lot better with that than cats. Dogs love it because they got all these new friends. Cats are like, don't like anything new. So I tried it. Since then, I haven't done it because he was just too traumatized. Now my neighbor, whom he loves my neighbor a lot more than he loves me. So he loves it when I'm out of town because now he's got my neighbor taking care of him. But yeah, they are doing that more. And that's interesting that business is becoming a bigger part of their business. It's certainly, they build trust on the product side. You know, they have a good clientele. It's great to have a business. You can take your pet into the business and no one asks you questions. So that's interesting. You know, she could definitely bring that up some about, you know, how much of their revenue is coming from that side. A chart right there that shows their service revenue versus their retail revenue over time as a bar chart would be great if she could find something like that. Where would you find something like that? Probably Capital IQ or Bloomberg would show you that. Capital IQ, you bring in the Capital IQ, you don't know how to do that, and just look at the segments. They may actually give you a break between the services versus the retail. That would be a great chart to add right there. She's making the point that's becoming more important. If you can show that as a graph, that'd be really, really strong. EPS was slightly missed and revenue eventually met. Petco's release shows a minor decrease in gross margin over that period. Gross margin was 39, falling short of expected. This made 95 basis points and missing 221 from last year. So again, it sounds like inflation's causing their costs to rise and it's not being offset with higher prices. So I'm not going to get into her discussion. It looks like she's doing a pretty good discussion. I don't know. It's going to be in the 90 to 100% range. So look at EBITDA and EBITDA margins. So it looks like she has that covered. I don't have time to go through in detail. She has some expectations going forward. So the only thing is on the talking about how the market reacted. So here she talks about, so she does have that in there. My only complaint is if you're going to talk about the market all in one place. Don't put it in two different places. That just, so I would recommend you put the market discussion all at the end. It just, to me, makes more sense. If you want to, you can certainly get your reader interested. You know, I'm going to cover Petco's earnings report and help explain why the stock market dropped so dramatically. So I want to cover Petco's earnings report and explain why the market dropped 17.5% on the day of the report. If you want to tantalize them there at the beginning with that kind of report, 17.5 is a huge drop, right? So if you want to bring that in earlier, just so they're like, yeah, I'm going to be reading this paper, I want to understand why that is, then you can certainly do that. Okay. So I'd probably give her 100 on the market reaction. On coverage, probably 90 to 92, critical thinking It's hard for me to say because I'm not reading it closely right now. Maybe 90, but it's definitely, whoa, look at that. She just set a record. So it's definitely an A paper, but exactly where it is on there, like there's some things I can certainly look at the detail. The way I read it on the clarity, I'm just that, it's obvious where I'm in the paper. It flows well. The paragraphs aren't too long. On the critical thinking, it's like, is she answering the obvious questions I would ask? Like that one thing on the revenue. She just said, okay, more revenue from services. Well, does she give me more information on that? Don't tell me that and just leave me hanging like, wow, how much more is it? Is it 5% now versus, is it 40% now? It used to be 2, or is it 3% now? It used to be 1. That's makes a big difference to me. If she can somehow say, which would be really interesting, what the margins are on the services versus the retail, that would be really interesting. I'd love to see a business that has higher revenue growth and a higher margin business. That would be great. So anything she can do that, those obvious questions that come up when you're reading something like that, that's what I'm looking for in their critical thinking. All right, any questions on all of that? So we've seen 2 good papers, which you'd expect, right? Usually, so you're like, yeah, I got a really horrible paper. Can you grade that in the class? You usually won't see that. So obviously, they have some confidence. Y'all getting a sense? Anybody else doing Petco? Are you doing it before, or are you doing it?
I think
Yeah. Petco's an interesting firm. I don't go there very often, but all right. So what firm am I going to value? I'm going to value a firm that whatever firm I do for paper 3 and 4, you can't do. So, yeah, I can do Walmart again. I'm getting so bored with Walmart, but I can. I heard a business breakdown this week that was really, really interesting, and I was going to do that stock, but unfortunately their recent numbers are really bad, so I can't do their stock. DoorDash doesn't work too well because they're not making money. So what companies are you going to pick for 3 and 4? So you want them to be profitable. And I listened to DoorDash's, I mentioned that to y'all, that I don't see it working. It's just, the story's not there. It's great that they're doing that, but for them to work, someone was asking about Edward Jones the other day. It's like, I don't like business models that for them to work, their customer is going to be grossly overpaying for the services. And that's why I feel about Edward Jones. For Edward Jones to work, they have to grossly overcharge their customers. I don't like those kind of business models.
Well, that's broken.
I don't know if they're publicly traded, but yeah, I don't know. But so you need a firm that's profitable, paying dividends, or get the free cash flow per share. So if you want to do a firm like a Google and Alphabet or someone that's not paying dividends, we can do it, but you need to come get the free cash flow per share from me, or I'll show you how they calculate it. Essentially what I do, just to keep, and this is essentially what Bloomberg does, is I take cash from operations minus CapEx. If you take that and divide it by shares outstanding, you'll get a good proxy for free cash flow. I realize this isn't what Dr. Katapackham teaches in his class. He has a much more sophisticated formula, but if you just need a quick and fast formula, and this is very, very similar, almost identical to what Bloomberg does, you can certainly do that. I don't like this because it assumes all CapEx is non-discretionary, that you have to spend it. A lot of CapEx is discretionary. Building new stores, that's discretionary. You shouldn't subtract CapEx if it's expanding capacity. The problem is we don't know how much of CapEx is expansionary and how much is maintenance. So you're kind of stuck with subtracting all of it. But you'll often get a much different number when you do that. And so you can certainly do that. You can do it twice if you want to. You can do it using dividends. If you got a firm paying dividends, you can do dividends and free cash flow and see if you get a radically different answer, because certainly a firm, a good example would be a firm like Apple. So I'll just give you an example. So Apple does pay dividends, 92 cents. I can't get used to their stock split. But if we look at their free cash flow, so their CFO is 122, 151. $122, 151. Their CapEx is 10,708, almost nothing. So their free cash flow and the number of shares. Go back to their income statement. Basic average shares, 16,216. So is there a difference between dividends and free cash flow? A little bit of a difference, isn't there? So for Apple, if you use dividends for Apple to value your stock, you're gonna get, it's gonna look like a really overpriced, expensive stock because they only pay 92 cents. They could pay $6, $7 in dividends easily. Probably a lot more than that because this is their free cash flow for this year. That doesn't count the 200 something billion in cash they're holding from free cash flow from previous years. They could pay a lot of dividends. They could buy USAA and you wouldn't even notice it in their financials. That's how much cash they have just sitting around. Not that they would want to buy USAA. I don't think anybody wants a bank right now. But anyway, so you can do it both ways and just see how big of a difference it makes. For a firm like Walmart, probably wouldn't make that huge of a difference, but for some firms, it makes a huge difference. But you can see how simple that is, right? You just have their CFO, CapEx, get your number of shares off the income statement, and you have free cash flow per share. It's really fast. It's a good ballpark number. And if anything, that 687 understates free cash flow because it assumes that entire $10 billion was a maintenance cash flow. All right. So they're paying dividends. It would be nice if they have positive equity. So you have an ROE when you're going to do the sustainable growth. If they have negative net worth, which a lot of firms do these days, you can't, there's no ROE, there's no return on equity when equity is negative. So you can't do that. Beyond that, I don't think it really, you don't need too much. You probably want to have an opinion on the firm. Business breakdown is not a bad approach. There's a business breakdown on Costco. There's a business breakdown on a lot of firms out there, like DoorDash. I don't think you can do DoorDash. I don't think DoorDash's free cash flow is positive either, just like their earnings. One of my favorite firms that they do is AutoZone, but AutoZone has negative net worth right now. I mean, you can do a firm with negative net worth. It's just you're going to lose one of the things you can talk about on growth. You just lose that one. So I think there's like 70 something business breakdown episodes now. A lot of them are smaller firms without earnings, so it is a little bit of a challenge. But no, I think they did UPS. I think there's an episode on UPS. It gives you more to talk about when you're trying to figure out the growth of the firm. The reason I like FND, Floor and Decor, is their business breakdown. They gave you really precise numbers to come up with your growth rates. So he went down and he said, this is what their EBITDA can be. They're 180 stores today. They're going to get to 500 stores. And you could And it gives you like everything you need for paper 4 on the growth rates. So you can steal that from business breakdown. But the problem is their free cash flow is negative right now. So you can't do that. Firm, interesting firm. It's not a firm I would have thought I would have ever been interested in, but it sounds like they're doing some pretty interesting things and actually giving Home Depot and Lowe's some issues. So that's what we're looking for. So I'll do Walmart, as boring as that is. So if we can do Walmart, we have paper 3. We have paper 4. For paper 3, we only need 3 numbers. We need a risk-free rate, a market risk premium, and we need beta. For paper 4, you need dividend 0, or free cash flow, EPS 0. You need an inflation rate. You need long-term growth, short-term growth, and an H. So you need a lot more stuff for paper 4. So essentially what papers 3 and 4 is documenting each of these assumptions, right? There is a video out there that walks you through this, but it's a couple years old. So it spends a lot more time on the risk-free rate than you'll need to spend on the risk-free rate, because the risk-free rate is now much more normal than it was in that video. So let's start with the risk-free rate. I would say tradition is to use 10-year treasury. You don't really need to talk about it much more than that. That's just the norm. People use the 10-year treasury. You could go on for 40, 50 pages on why the 10-year instead of the 5. There's plenty of places out there that you can Google. I might do a graph, put current rate in perspective, and then use current rate. So in the past, you had a debate, hey, can I really use a 10-year treasury that's below 1%, below 2%? Do I need to adjust it in some way? So you had a few paragraphs of discussion. Now all you have to do is say, hey, the tradition used a 10-year treasury. It has been unusually low the last few years, but it's back to a more normal level. Therefore, I'm going to use the 10-year treasury, and you have a graph that shows that. How do you get the graph? Well, it's pretty straightforward. I think you can even do 10-year treasury spread. I think the Fred even will do it for you. So it's not as big of a deal, but I still think people are thinking, is this rate too low? I think right now what people are thinking is the 10-year treasury is at 3.5%, and the last inflation number was 5%. Can we just use that 3.5 and realizing that the real yield is negative? And I think, yes, you can. So let's go back. Max. Oh, I don't. That's the spread. That's not what I wanted. There we go. So it doesn't take very long. That's me messing up twice. It doesn't take that long to get a good graph of the 10-year treasury. You can go back to 1962. You can see the nice thing about the Fred, and you can, if you want to, on the paper, you most definitely can. Just make sure Fred's in there. Don't put stuff in it that you don't know what it is. Do y'all know what this stuff down here is? If you don't know what it is, don't put it in your graph. So I'm gonna take that. Fred, you messed up. Let's do it again. Be careful when you have to, well, you can't have it over the graph when you do it. There we go. that's a pretty easy part of the paper now. It hasn't always been. You're down to one paragraph instead of 2 or 3, but pretty straightforward. Are we really back down to normal? Back to normal, back up to normal. We're definitely back to normal versus the last few years. We're still well below where we have been, but also inflation has been much higher in the past and is coming down. If you want to spend more time on that, you certainly can, especially the inflation versus the current yield. But any questions on the risk-free rate? All right, then the market risk premium. Here are the points I would make is I'm going to use the implied approach and explain. So for my market risk premium, I'm going to use the implied approach, which assumes the required return on stocks equals the current expected return on stocks. The expected return on stocks is a function nominal GDP. You know, just go through the entire discussion. Nominal GDP growth equal productivity growth plus labor growth plus inflation. And then you talk each of those and you get final assumption for the market. Be real careful in here. I count off a lot of points. You're not talking paper 3. The only time you talk about your company in paper 3 is on the beta. There's nothing about your company on the risk-free rate. There's nothing about your company on the market risk premium. You don't care how fast your company's earnings are growing. We're talking about the growth of the overall stock market, right? Very, very, very important. So I've given you those charts that you can certainly use here in this part of the paper. I just can't remember where I put them, but maybe it's under miscellaneous. No. No. So I don't remember where I put them. Yeah. Oh, I have to put them out there. All right. So I'll have to put them out there. It's in the, well, you have them. It's in the class notes in the Word document, the class notes. So you can find them in there. I forgot I did that. So yeah, on the class notes. I used to have it as a separate file, but I said, I'll just put it in the notes. Nothing happens. You can find them pretty quickly because there's not that many graphs in the class notes. So it starts on page 16 of the class notes. I have a typo in mine here. Yeah, I got a typo here. Sorry. I messed up. Let me do this again. So the expected return on stocks is what? Dividend yield plus expected earnings growth. Sorry about that. Sorry, I got this stuff out of myself. So the expected return on stocks is dividend yield plus expected earnings growth. Expected earnings growth that is a function of nominal GDP. All right. And then you have a chart that demonstrates that. This chart here shows you that the stock market historically has really produced dividend yield plus earnings growth by decade. So you can definitely use that chart in your paper. I did adjust this chart a little bit for stock buybacks. It didn't have a huge impact, but I did adjust some of it. So it's a little bit more than just dividend yield, but not a lot. If you want to get into the stock buybacks, you certainly can. I'm going to leave that up to you. That adds about 1% or so to your expected return on stocks. So I went back and I looked at it. I forget how far back I went. Back to 1999, so pretty far back. So the blue is the dividend yield, the buyback yield. And the red is the dividend yield. You can see in 2008, firms actually issued stock. Probably a lot of those were banks because they're so undercapitalized. And so you can see, you see the shift from buyback yield being pretty small to being dominant. Then we had the 2008 crisis. Then it kind of came back. They've been pretty equal. And then 18 and 19 and 21, the buyback has come back mainly because of those huge tech companies. They were buying a lot of their stock back, and not just them, the restaurants as well. So the case is still really strong for a buyback yield. The last few years, it's actually been quite a bit above 1%. In 2020, obviously, it dropped down back to 1. I think these are somewhat inflated. This was talking, I think, Thomas, you were asking about it. I think the last 4 years, I think, are somewhat inflated because the tech companies were just bringing in the cash. And obviously 2022, which I don't have in here yet, 2022 was a little bit of a pullback for them. So I think those 3 years where you're well above 1.8 or above 1.8, that to me is an exaggeration from the tech companies. So I would add somewhere, if you want to add it, somewhere between 0.5 and 1%. I wouldn't go above 1%. I just don't believe that. All right, and then the expected earnings growth of stocks. So here we have this chart that you can certainly use. And this just shows you that historically corporate earnings growth have been 6.41%. Our economy has grown 6.47%. So you can certainly justify your forecast for corporate earnings growth, tying it back to economic growth, because they have essentially matched, although most of it's come just in this last period where you had really rocketed up earnings growth when the economy didn't rocket back up. So you can use this chart to justify that. So you have a chart that justifies that one. You have a chart that justifies this one. And then we have a chart. I'm running out of colors. Justifies that one. This chart, almost everybody puts this chart into their paper because it really does help your case. So I would definitely have this chart in there to justify. That's where I say economic growth, 4 to 6% range makes sense to me. So you might have a little bit of discussion on maybe a paragraph on productivity, a paragraph on labor, maybe something on inflation. I've heard some students talk about forecasting productivity and labor by going out and finding a forecast. Don't do that. You're not forecasting productivity for next year. We're talking the next 50 years. All right. The fact that someone says productivity is going to be 1.5% next year, that's meaningless to this analysis. We're talking the next 50 years. That's why I've given you 50 years of data. So you can look at the history and talk about it. But where's the growth going to come from? If productivity is about 2%, labor growth, be lucky to be 1%, inflation maybe 3% or whatever, 2.5%. You're going to have a tough time getting above 6%. It'd be strange to be below 4% because that would be kind of a disaster scenario, right? So you have some charts that you can use that come from the class notes, starting on page, whatever I said. So 16 and 17, they're all on pages 16 and 17, which by the way, goes into this whole discussion about expected return on stocks, all of that. I don't think I have the buyback yield in here, but you could certainly bring that in as well. There's probably some pretty good papers that maybe update that even more. They can, if you want to add some. Now, some students think, well, is it going to affect my grade, which is fine. Some students are like, yeah, I'm going to do that because I need to know that. So it depends. Do you want to get a degree or do you want to be a world changer, highly successful, your choice. So, so you can certainly do that, not to impress me or get a good grade. You can do it just so you know what's going on. So you can talk about it in an interview, what the big issues are. So you can research this yourself. You don't have to, but you certainly can. So I'm going to go the dividend yield. Right now, how do I get that? Well, I just go get the dividend yield on SPY because SPY is the S&P 500. So if I go into Yahoo Finance and type in SPY, SPY comes up. The dividend yield is 158. So I've got that number. If you want to do buyback yield, you can. You'll have to have a little discussion. Let's say that's about 1% or less. And then expected earnings growth. Here is you got to come up with your assumptions. So come with your own assumptions. You look at the history, productivity about 2%. Labor growth's been about 1%, and say inflation maybe 2.5%. I don't know, whatever assumption you're going to make. That gives you 5.5%. Something that you can justify, but your own numbers. And it gives us expected return in stocks. And you can round if you want to. Of 8.08%. I mean, you can use 8%. If you don't want to use 808, you have too many decimals you have to worry with. And so my market risk premium is going to be what? It's going to be expected, my word, expected return stocks minus the risk-free rate. So 8% minus, where is my 10-year treasury? Oh, I never gave us the 10-year treasury. Current yield, rates were down today, but not much. So you go to Yahoo Finance and just find the 10-year treasury. There it is, 3.42. So 8% minus 3.42 gives me 4.58. It's going to be probably in the 4 to 6% range. If you want to confirm, if you want to add more to your paper, you can do Damo Darren market risk premium. He's the guru on this, and you can certainly find his stuff. It's Damo Darren, just like it sounds. He has all kinds of online free stuff that you can use. And he has entire Excel spreadsheets just on the market risk premium. And it takes forever. So, and you can just do a search on the word premium. Implied equity risk premiums, United States. That sounds pretty promising, doesn't it? So you click on that and there it is. I think I showed you, did I show you all this last class? Was that my other class? So he's saying it's 594. That sounds really high. Why is that so high? Well, that's last year and he did this before interest rates rose. So he's probably using the same 8% that we're using, but he's subtracting a much lower treasury. So his number would probably come back down to the 4% range this year. But he's doing the implied approach as well. So it's a very similar type of analysis. So he's using about 5%, but that's because of where he was. I don't know if he has a 10-year treasury in here. Well, if he's using T-bills, here's the T-bond. It's actually getting up there. So I'm not real sure why his risk premium is so high right now. He did something to cause it to jump. But I'll just warn you, don't go below 4 because it's going to cause you serious problems in paper 4. Remember, if your discount rate's too low, your growth rate has to be below your discount rate. So if your discount rate's too low, it's going to really limit what your growth rate can be. So I would not go below 4 on the market risk premium. Above 6, you're getting a little bit in the no person's land, I would think, even though he's pretty close to that at 594. But you know, it's rare for him to be above 6 at any time. There's a few years, there's only 2 above 6. So he's got a lot that are even below 3 and below 4. So yeah, it's 4 to 6 is going to be your, and I'm not saying for this paper, I'm saying just what you think about market risk premium. Let 4 to 6 be that normal range. So if you're in an interview and someone says, yeah, I'm using market risk premium 8%, you should feel very confident and say, wow, that seems really high. 8% market risk premium. Why do y'all use such a high premium? That's pretty cool, isn't it? Because most finance students would just sit there, 8%. Yeah, they do the, I know what you're talking about. Fake nod that people do. Yeah, 8%. That sounds right. And you're the one that says, no, that seems awfully high. Why would you use 8%? That's the much more informed reaction. So just get used to the market risk premium being that 4 to 6% range. All right, and then beta. You notice I haven't referenced Walmart yet. So you don't need anything on Walmart yet. On the exam, for this part of the question where you come up with the discount rate, I give you Walmart's dividend yield. And what do you do with that? Absolutely nothing. There's no place in here you need their dividend yield. You need their dividend, but there's no place you need their dividend yield. So if you're using the company's dividend yield on exam 1, you're making a mistake because there's no place anywhere on that exam you need their dividend yield. If I give you Walmart's expected growth in earnings, along with what I think the market says, you ignore that for your market risk premium because it has nothing to do with Walmart, right? I give you the number, but it has nothing to do with the market risk premium. So the only time we need Walmart is here. Remember, we got 4 steps. You're going to do the 4 steps. The first is revenue sensitivity and operating leverage, financial leverage, and history. Revenue sensitivity is just a discussion. Walmart is clearly a defensive, low beta company. Pretty obvious. Now, if you don't like this part of the paper, then pick a company for paper 3 it's obvious whether it's defensive or cyclical. Okay, that makes one part of your discussions a little easier. And spell defensive correctly on paper. I don't even know how I even did that. And in operating financial leverage, I have a file. I'm in the process of updating it because I want to get 2022 data in there. So I'm going to get it out there as pretty soon. You don't have paper 2 done yet, so you don't need it. But I'll get it out there pretty soon. But just looking at it, there is a file out there. It's called, no, it's not out there. Let me find one from a previous semester. So I want to update it so that you have the most current data possible. And it's a massive spreadsheet and it uses Bloomberg. So it takes because I'm bringing in 3,000 companies and I'm bringing in their gross net margins and their debt to equity for the last, like, I forget how many years. It's a lot of years. It's just some massive files. So I'm bringing in over 130,000 pieces of data. So it's a massive, massive file. So what you want to do is I'm doing Walmart. So what you want to do is you want to go to this second page and find your company first. So there's Walmart. So it's on line 2963. And then when I come back here, I can just change this to 2963. And then I've got all my data, right? So find your company first and then change that. So it's Walmart. So I'm going to bring this in, and you can bring this into your paper. You might clean it up a little bit so it looks a little bit nicer, but especially, I don't need that thing so massive. Right. So for operating leverage, you're going to have a subjective discussion. Go back to the class notes on that, but where does operating leverage come from? So we're talking about how much fixed costs they have. Are they mainly salaried employees or mainly hourly? Hourly is going to have much less fixed costs than salary. Are they heavily unionized? That's going to create a lot of fixed costs for you. Do they have a lot of property, plant, and equipment? That's going to give you a lot of depreciation. That's going to make your earnings more volatile. Do they have a lot of R&D they got to spend? They have a marketing budget they got to spend. Where are their fixed costs? And then discuss the standard deviation net margins. You can ignore gross margins if you want to. So here I have the US stock market. That's standard deviation. Make sure you know this is standard deviation. This is not the net margin. The net margin of the stock market is not 7.4%. This is the standard deviation. The standard deviation of margins for the typical stock is 7.4%. Walmart's is less than 1%. That to me implies very low fixed costs because their earnings are very, very, very stable. In fact, it doesn't really matter to me if they have high or low fixed costs. The whole reason we're talking about operating leverage is how stable their earnings are. So maybe they have high fixed costs, but they're able to change their revenues around that or whatever. So whatever, we can say low fixed costs and very stable net margins. So low beta. They're one of the most stable firms out there. They rank in the top 2.7% for just really, really stable earnings, which you'd expect with the Walmart. Walmart's customers understand that if coffee prices are up, that Walmart's going to charge more for coffee. It's not like they say, wow, why are you charging so much for coffee? I mean, it's not. And Walmart's not going to charge you $10 for coffee if they can charge you $7 because Costco is going to charge you $7. HEB is going to, so it's competition. They're all going to have very similar margins. So, the customers are pretty used to that. Yeah, costs go up. How many people were mad at HEB for egg prices this last year? You see anybody protesting HEB? Whom are they mad at? They're mad at the egg producers, right? Anybody see people with signs in front of HEB? Egg prices too high, you're ripping us off. You hear anybody talking about HEB ripping them off on egg prices? Don't most people understand that that's not their fault, that they're just passing that along? So they tip grocery stores can pass most of their higher costs on to their customers. That's not that difficult for them to do. All right. Financial leverage, Walmart, this is debt to equity. It's not standard deviation of debt to equity. This is the actual debt to equity. They're at 62%. Stock market's at 56%. So slightly higher financial leverage, maybe slightly increasing beta, but not much. It's probably not going to have that much impact on my view on beta. And then history. So what I'm going to do for history is I'm going to provide you the file of the S&P 500 because Yahoo Finance has stopped allowing you to download that. I don't know why they did, but you can no longer get the S&P 500. If you look on Yahoo Finance and you ask for all the data, everything's there except for the download button. And if you copy and paste it, that doesn't work because the months are off. It gets really frustrating. So I've given you the data. So all we got to do is get the data for Walmart. So I'm going to put that file out there eventually. I probably have it right now because we'll just stop in March. You're going to be doing this paper in April, so we won't have April data anyway. So all I need is Walmart. So I'll go to Walmart historical data. We're going to do the max historical prices. We're going to do it monthly, apply, download. We've done this before in class, so just refresher. And there's a video that shows you how to do this again. So we just need historical prices for Walmart. Eventually it will work. So there we have Walmart. And the only number you need is the adjusted close, so you can get rid of everything else. We're just going to go through March. Don't worry about the 1 on the date. That really is the end of the month. I don't know why they have a 1 there. So I'll put Walmart right here and just make sure the dates line up, and they do. So there's Walmart. I'm going to switch it. I'm going to put Walmart on the left, S&P 500 there. And then I'm going to do the holding period return. Walmart, you remember that holding period return for the market. So, well, I'll do the formula we did. Ending value minus beginning value divided by beginning value. Why is there no income? Because I'm using adjusting close. Adjusting close has the income already in there. So there's 1 month. All the way down. And then we're going to do the rolling beta. Not sure why Bill Gates thinks I want. Here's there. So we're gonna do 5-year monthly because that's what Yahoo Finance has. So 5 years times 12 months is 60. So we're gonna go down 60 months. We're gonna do the equal slope. Walmart versus the S&P. So there's my starting. Now you notice, I think we did this in class. I think at the Walmart in class, their starting beta is really high because it's a small company. And so I'm probably gonna say, you know what, it starts at 1.3, but when I get my central tendency numbers, I'm gonna start in 2003 on row 218. So kind of look at the data. You may have to do it a few times. I'm going to do equal percentile, but I'm going to start at 2003 for Walmart. For your company, who knows what you might find. So that gives me the 50%, the 10%, and the 90th percentile. So I'm just going to graph that. Oops. Now, before I do that, I might compare the very, very last number, that 0.49. Should be almost exactly the same as what Yahoo Finance shows. 0.49. And why is that? Well, what do you notice on the beta? 5 years monthly, exactly what I just did. It could be slightly different because they may have the April number in there. They may be using closing prices, not adjusted closing prices. I've never seen it off more than by 0.01. So if you do this and you get 0.87 as your last number, then you probably messed up somewhere. It's not going to be that far off, right? So that gives me great confidence, right? It's the same number. And so I can now graph it. Put my dates in there. And do some formatting. Don't give me a messy chart. I don't know why I did that. Oh, my word. Bill Gates, you can do better than that. Okay, so Bill Gates is messing up. I don't know why he's messing up. So I got Walmart rolling beta, 5 years monthly. So I got my chart. That messed, oh my word. Okay, Bill Gates is really messing up today, so sorry about that. I can't control him. You probably want to make sure you paste it as a bitmap, just so it doesn't mess up the charts. So he's going to say that's my fault. Make sure you have your labels here. Don't have series 1, 2, 3, and 4. So series 1, that's the rolling beta. Then you have the median. Then you have the 9.9%. So their median is 0.4. Histories suggest 0.35 to 0.6 or so. And then you have your final beta where you're going to bring all this. That's, remember I said I recommend you do a table with all 4 of those. So you say what your final recommendation is. I'm going to use 0.6 for them. But there's more than one right answer. A wrong answer would be like 1.8. That could be really wrong. But there are a lot of possible answers. All right, so there's paper 3, and we'll final thing we'll have is our discount rate. So on Monday we'll finish up paper 4 for Walmart, and you'll have everything you need. All right, we'll stop it there.